while complications may still arise, indications are that the debt ceiling agreement will pass through Congress with support from Republicans and Democrats. We see the deal as a positive for investors. Neither the far right nor far left on the political spectrum likely will be happy, but we think the agreement demonstrates that, at least in very dire circumstances, Congress can rise to the occasion. Let's take a closer look at the deal and its potential impact. The agreement negotiated between U.S. President Joe Biden and U.S. House of Representatives leader Kevin McCarthy doesn't raise the debt ceiling, but rather suspends it until January 2025, so past the presidential election in November 2024. The deal includes spending caps of about 1% a year over the next 6 years. By some accounts, this reduces the estimated budget deficit by about $2 trillion over the next 6 years. As to the impact of less government spending, most early analyses of the deal project a small headwind to U.S. economic growth, in the range of 0.1 to 0.4 of a percentage point. U.S. equities have been well behaved, likely a sign that investors believed the crisis would be resolved in time. With the government saying it may run out of money without a deal as early as next week, money market yields from June to August rose last week. However, the market has settled down since. It's worth keeping in mind that this isn't over until Congress and the President enact the agreement into law. If issues pop up as Congress considers the agreement this week, then the government and investors may face technical default next week. That could potentially lead to an equity sell-off and some dysfunction in the Treasury market. In that scenario, we think Congress would quickly change its tune and resolve the debt ceiling issue to avoid more damage, likely making the market volatility brief. Still, even a brief period in technical default could have very costly longer-term consequences, particularly if the market came to demand a higher risk premium for lending to the U.S. government. Our base case has been that the debt ceiling impasse would be resolved, and the relative calm in U.S. financial markets of late suggests that investors too have been assigning a low probability to a technical default by the U.S. government. Turning to the potential implications for U.S. monetary policy, and likely also reflecting better prospects ahead, investors' views on the likely near-term path of Federal Reserve policy have shifted markedly. Futures markets have gone from pricing in, a few weeks ago, a very small chance of a rate cut at the June meeting, to now pricing in roughly 50-50 odds of another hike then.